I'm got it.
We're all good.
Okay, wonderful. Again, hi, my name is Alex and I'm from Transition Consultants. I'm here to talk to you about medical practice valuations and current trends in physician practice transactions. As Stephanie mentioned, I am a healthcare valuation professional. I valued over 500 practices. That includes medical practices, optometry practices, podiatry, surgery centers, and so on. Most of these transactions have been for mergers and acquisitions, some for dispute and divorce. This is our agenda for the day. We will first cover several topics concerning the practice valuation process in general. We'll talk about the three generally accepted valuation approaches. There are income, market, and asset approach. And we'll talk about some of the key value drivers that you should know in the process of the valuation of the medical practice valuations. In the second part of the webinar, we'll talk about different kind of buyers, what are they looking for, some of the pros and cons for each one of them, and I'll wrap it all up with some of the interesting engagements that I've had in 2022. Let's begin with practice valuations. Why are practices valued? Mergers and acquisitions is number one. It's your typical buying and selling process, valuations for, in order to help a physician get in or out of the partnership. Buy-sell agreements, these are often overlooked. If you're in a partnership, make sure you have a buy-sell agreement in place. Unfortunately, not all partnerships end on good terms, and having a buy-sell agreement that will spell out exactly how the valuation should be done in case one of the partners wants to exit could save you a lot of money in the future. You want to speak to your attorney regarding that. Marital dissolutions. Medical practice is a marital asset and it will need to be valued in a case of divorce. Allocations of a purchase price. In the event of the business sale, buyer and seller have to agree on how to allocate purchase price among all the different asset classes. That is done because different assets have different tax treatments. There are also valuations for financing, such as SBA loans, stockholder disputes, etc. Who values practices? There are many sources where you can get a valuation, not just these three. You can get a valuation on the internet for $99. You can go to a business broker, to your accountant, and I'll talk about these three because usually these are the most relevant to us in the healthcare space. Business brokers. Business brokers have a distinct advantage because they're involved in actual transactions in the marketplace. As a result, they're more familiar with the market and the business that is being appraised. However, many business brokers don't get an actual appraisal training. They're generally salespeople. Their opinion will likely be very informal because of that, and they often like to rely on rules of thumb, which sometimes they create themselves, and that can be dangerous. Business brokers usually would not be involved in valuations for litigation, divorce, tax, etc. They're more limited to mergers and acquisition area. Then we have accountants. Accountants, on the other hand, are well educated in financial concepts and terminology. They understand financial statements better than anyone in this group. Because of their training, they're also exposed to revenue rulings and tax laws. On the other hand, accountants can be, they might have to be concerned with some potential conflicts of interest. For example, if your accountant does your taxes and you hire them to do a valuation, in the valuation, they might need to normalize owner's compensation, for example, and that creates a conflict of interest. Accountants can also be perceived sometimes as being biased in certain engagements. Overall, I believe accountants are your very valuable advisors. If your CPA does not have experience or training in the valuation, you can still go to them and ask them for their help in order to find someone who does these valuations, especially if we're talking about something as specific as medical practice appraisals. Lastly, business valuation analysts. Business valuation analysts are those individuals that provide business appraisal services as their main area of focus. They're generally well educated in business valuation. They have understanding of issues in the fields of economics, finance, security analysis, and accounting. They often have accreditation or are pursuing accreditation from a professional appraisal organization. One difficulty that these professionals might have is they're usually exposed to a very particular kind of business. And this will be their area of expertise. For example, if I do medical practice valuations, most of the time, I might not be very comfortable doing valuation of a car dealership, for example. I can still do the valuation, but it will take me longer. So I might just refer it out to another analyst who specializes in that field. Selecting an appraiser. Bottom line, anyone can call themselves an appraiser. The appraiser simply gives you their opinion on the value of the business. Ideally, I would look for these two things. Number one, find someone with experience in valuation of your type of business for your valuation purpose. If it's a medical practice, find someone who values medical practices. If it's a gas station, find someone who values those. Second, ideally, look for someone with a valuation credential or certification. It is not a requirement. I have seen awful valuations where people have amazing credentials. However, it's good to know that the valuation professional that you hired have received some business valuation training. Also, their valuation report will be compliant with certain standards. These standards are assigned by the governing body that gave them the certification. Here are some examples of the valuation credentials that you might encounter. ABV, this is a credential that is given to CPAs by ASCPA. There's a CVA, which is what I have, the Certified Valuation Analyst designation given by NACVA. There's CBA, which is Certified Business Appraiser. Those are not issued any longer, but you might still encounter them. And we have an ASA, which is an accredited senior appraiser that is given out by American Society of Appraisers. Moving on to actual three approaches. So how do valuation analysts come up with the value? There are three generally accepted approaches, and there are many methods under each one. So under asset approach, there'll be many methods. Under income approach, there are multiple methods as well. Market approach. This one is the most fundamental approach in the fair market value appraisal, since the fair market value is supposed to come from the market. This one is usually the easiest to understand, in my opinion, and from my experience with my clients, because a lot of people are experienced with comps in real estate. Just like when you're looking to buy or sell a house, you look for comps in the area for a similar house. Here we're going to look for practices that are in your specialty, ideally in your state, and we'll compare those to the practice that we're trying to value, usually using multiples. We can take a look at a quick example here. As you can see, this table has some data on pediatric practices, family medicine practices, and internal medicine practices. We're given revenue, price, earnings, and from that data, we can calculate multiples: price to gross, revenue, price to earnings. Usually the data is screened, for outliers, for location, size of the practice, etc. But ultimately, we take this data, calculate a multiple, and then apply it in our valuation to our practice. Asset approach. This one is commonly known as a cost approach. It's most commonly applied to asset-intensive businesses. For example, if you have a primary care practice, you might not have a lot in terms of assets. It could be 10,000, 15,000 for a solo doctor. However, if we were to value, for example, a surgery center, the value of all the assets in the build-out in a surgery center can be worth millions of dollars. So this approach gives you essentially a floor value. Each asset is valued separately. So we look at the value of medical equipment, the value of furniture, We can sometimes put some value for the workforce that you have in place. And if you have any valuable contracts, in some cases, you could also calculate value for those. It's usually reserved for either, as I said, asset intensive businesses or practices that are doing really bad. High value practices like nursing care centers, were many locations, but they were losing money. So although revenue was $5-6 million, the business was showing loss every single year, and the owner had to put money into it. I could not justify valuing this business based on the other two approaches. I went with an asset approach. Here's a quick example. This is basically how it's going to look. On the left side, you have a list of assets, liabilities, and equity, and the balance for each account. We made 3 adjustments here. Accounts receivable is typically off-book accounts, so we added, let's say I believe 75,000 is what the accounts receivable is worth. I added 75K here. Second adjustment was for fixed assets for $100,000, and I added some value for workforce in place, 25,000. So by doing these adjustments, we increased the value of equity by 200,000, as you can see on the bottom. So the equity went from 107 to 307. And lastly, income approach. The income approach values the enterprise based on its cash flow generating abilities. It revolves around calculating a future benefit stream and then valuing that benefit stream using a company's specific rate of return. This is a very simple, very simplified equation as an example of what this means. There's also different discounts and growth rates that are, you get involved that are an income approach. So to simplify it, I'll show this example. For example, a business generates $100,000 a year in cash flow. As an analyst, I determined that the risk rate for this business is 35%. You divide 100,000 by 35%, gives you a value of $285,000. That's a simple, very simplified version of an income approach. And lastly, if you're getting an appraisal, your analyst will look at the value of the business under all of these 3 different approaches. In a perfect world, all methods would give you the same value. Unfortunately, we don't live in a perfect world. So the analyst will have to weigh pros and cons of each method and then allocate a certain weight to each of those in order to calculate the value. So for example, we looked at 3 different approaches. Income approach came up with $100,000 in value. Asset approach with $20,000 in market with $50,000. Analysts will look at all 3 and decide which is the most reasonable. And we'll weigh, I could weigh maybe income approach 100%, 0 on the other 2. Maybe if the approaches actually come close together, I would weigh them maybe 50-50 for 2 approaches, 0 for the third. Usually they're kind of not necessarily mutually exclusive, but like you will not usually apply an income approach and an asset approach in a medical practice unless its ability to generate cash flow is equal to the value of assets that it has. But it's very, very rare. Probably wouldn't happen. Now moving on to key factors determining medical practices value. I will touch on 2 different topics, seller's discretionary earnings and EBITDA. Today's buyers look very carefully at what economic benefit they can get out of their investment in the practice. Back in the day, medical practices sold for 1 times gross, and that was it. Today, earnings drive the value ultimately. You can have 2 different practices, both going to generate $1 million in revenue. In one, the owner is going to make $500,000. In the other one, the owner is going to make $100,000, working equal number of hours. Obviously, the value is going to be very different. As a result, seller discretionary earnings is a measure of business earnings in an owner-operated business. Usually in businesses with revenue under $10 million, their major driver is SDE. Essentially, what SDE measures is a total economic benefit the owner gets from the practice. Here are some examples. You might be driving a Bentley, but you might not need a car for work. So we could add the auto expense to the profits of the practice. Your trips to Hawaii might not be necessary. We could add them as well as as actual cash flow of the business. Rent is very common. A lot of doctors like to own the property where the practice is located. The way it plays into the valuations. If you're overpaying rent, we could normalize rent down, which will create more cash flow for the business, creates more value. If you're underpaying rent or not paying rent at all, I run into that sometimes, we would need to actually increase rent because hypothetical buyer would obviously have to pay rent to someone, or even if they buy the property, that's just the way to keep those two assets, medical practice and real estate, separate. Family member compensation is common. If you have a family member that is on the payroll, but they're not working in the practice, their adjustment will need to be made. We'll remove their compensation because they're not needed there. And retirement plan contributions obviously is very common. Anything that you put into your retirement plan is not necessarily a business expense, so we can add it to SD. Let's take a look at a quick example. In this table, we have a very simplified version of profit and loss statement. And in yellow, I highlighted an ordinary income. So this information in the top section usually comes from a tax return or a profit and loss statement. And the ordinary income obviously factors in all the different expenses that you are putting into your business. It could be just all the items I just mentioned, they are playing into this ordinary income by reducing it usually, right? The car expense will reduce ordinary income. So what we do is we calculate the seller's discretionary earnings by taking their ordinary income, which is in yellow, and adding back the discretionary items or maybe non-recurring items. So in this case, we added, so let's look at 2022. Ordinary income was $283,000 for this practice. We added compensation of officers, which is a W-2 compensation that goes to the owner of the practice of $120,000. We added some pension expense, auto expense, and travel. And you can see that ordinary income was $283,000, but the SD is much higher, it's $450,000. $450,000 is the actual benefit that the owner is able to pull out of the practice. They could drive a Bentley, they could have their own airplane and write those things off, and it's not going to be shown on their ordinary income line. You need to add those things back to figure that out. And that is the number, the SDE, seller's discretionary earnings, is the number that the buyers are looking for. They want to know, okay, if I come in, how much am I going to be able to make? How much money I'll be able to distribute to myself if I want to? Next one is EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is another indicator of practice's profitability. It is often used by private equity firms to do quick calculations of value for their investment. The key difference between the seller's discretionary earnings, the number I just shown you on the previous slide, and EBITDA is that we need to make an adjustment for owner's compensation. Let me show you what that means. The seller's discretionary earnings comes from the previous example. We calculated SDE to be $450,000. Here it comes, total SDE, $450,000. And in this example, we assume this is, let's say, a family medicine practice with the owner, a family physician working full-time. Family doctors, let's just say in LA area, let's say they make $250,000. We assume that the fair compensation for an owner would be $250,000. We take $450,000, which is our SDE, take out $250,000, leaving us with $200,000. That is our EBITDA. The owner adjustment is needed here because the benefit stream is viewed from the perspective of an investor. If investor buys the practice, they'll have to hire someone to see patients and do what the physician does there. For that reason, private equity groups use these multiples. They want to see, okay, how much actual cash flow we will generate from this business after paying all of the expenses that are needed to be paid in operation of this practice or business. Finally, let's take a look at some buyers. I'm going to highlight 3 categories, and in the end, I'll mention a couple of interesting transactions that we've had in 2022. Private equity. Everybody knows that private equity firms are aggressively entering the healthcare space. They're buying up practices nationwide, employing doctors through, there are obviously restrictions on corporate practice of medicine in the United States, and in most of the states, they usually do this through having medical corporation that is owned by a friendly physician and a management company that is going to have a contract with the medical corporation. The management company is going to employ all the non-providers, so your office managers, MAs, billers, et cetera. It's going to own all of the assets that are needed in operation of the practice, and it will get paid some kind of a fee. Usually, it's a percentage of revenue, et cetera. That is, they use two together to go and buy practices. What I want to say about private equity is that not all private equity groups and buyers are the same. If you're a seller and you want to work for a few more years after the sale, make sure you look for those groups that have established operations. Ideally, 5+ years, I would say. PE buyer may be able to get you a top dollar for your practice. That is true. They have usually a deep pocket. A lot of times they can offer more money than, for example, individual doctor can pay. But make sure that they don't just impress you with a high offer and lock you up into some kind of an agreement. Consider all options first before accepting an offer. Understand the deal structure. That's very important. Don't focus on just the price. Private equity groups love to do earnouts where they'll pay a portion of the purchase price to you, not at closing, but let's say over a few years. And that earnout is going to be subject to you hitting certain productivity targets. They want to make sure they're going to continue making money going forward. So they want you to have vested interest in that. Due diligence process with private equity firms can be a challenge. Don't be surprised. You might get a 10 to 12 page document with the bullet list of all the information that they want to look at. It can easily take 3 months to go through it. They will want to see your financials, productivity reports, legal documents, payer contracts, employee handbooks, retirement plan documents, you name it. It's quite overwhelming. So hopefully you have a good support system around you. A few deals where I've done where there was a really good accountant involved, made my life very easy. In some cases where it's a very small practice, it was a big headache. It took us, sometimes more than 3 months to complete the due diligence. And also, obviously, due diligence doesn't mean that the deal is going to go down or that the price that you were offered is going to stand. It is possible that once they do the due diligence, they'll find out, hey, this thing is not as valuable as we thought. And there's always a possibility of adjustment. That's why I said in the beginning, consider all options, really interview everyone hard, make sure you're on the same page. As I mentioned, private equity groups love to pay EBITDA multiples. The EBITDA multiple, the multiple itself depends on the group and their appetite. Things like number of locations, number of providers, productivity per provider, just general, stability of earnings. Many things kind of go into play when you're trying to pick a number for the multiple. And ultimately, their agenda is profitability. They want to scale the operations as fast as possible. They can be very aggressive doing that. That's why they will pay top dollar, because they're leveraging the cost of debt, which is usually low. It's a lot cheaper to get to finance through debt than through equity. So they will scale as fast as they can with the goal to sell the bigger entity that they build to a bigger buyer down the road, and ideally for a bigger multiple. So for example, when let's say a private equity group goes around buying physician practices and they pay 4 times EBITDA. They buy. After a few years, they roll those in together in that one entity and they sell it to someone for 10. So they make profit on the difference in that multiple. And obviously they try to streamline operations and make things more efficient, make it more profitable. Hospitals and health systems, between 2019 and 2022, the percentage of physicians employed by hospitals and health systems went from roughly 47% to 52%. We all know that younger doctors don't go into private practice anymore, or the very reduced numbers. And the physicians the hospitals and health systems are growing number of physicians that are employed by them, not just through hiring, but through buying practices. I'm sure many of you were either involved in a transaction or were reached out to your local hospital, the hospital reached out to you about selling the practice. There's a common misconception that hospitals do not pay for goodwill. They do. If they don't have to, they won't, but they can. Okay. If you can negotiate, do it. You can get a valuation and then use that to negotiate your position and get at least something for your goodwill. Ultimately, the agenda of the hospital and health system is to control the referrals and to either build out a service line or support a service line. One thing to keep in mind with the hospitals and health systems, they usually want you to stay for a pretty long time for a transition, usually longer than others. Private equity groups can depend on the group, but hospitals like to pay you a small amount for the practice, ideally value your assets, as I mentioned to you what asset approach was, and then give you a nice compensation package and employ you for the next few years, 5 years. That way, slowly taking over the practice. And at the end of 5 years, you'll have another physician and you can retire or do what you want to do. And lastly, individual doctors. Yes, it's true. A few doctors go into private practice these days, but many are still in a private practice. The benefit of working with an individual doctor includes a pretty, usually an uncomplicated due diligence process. Financing is readily available to physicians, up to 100% of the purchase price, plus working capital. Many major banks have programs specifically for doctors. If you're not profitable enough for a private equity group, you may be able to sell to another physician. And individual physicians are obviously buying practices because of the income potential and they like the lifestyle. They usually want to become a business owner and control their destiny, basically. Here are some of the interesting engagements that we've had in 2022. Cosmetic dermatology practice in LA County. So that one was sold to a PE buyer. It was a decent sized group. They paid 5 times adjusted EBITDA for the practice. This was a single owner, and the doctor was extremely productive. So they really wanted him to stay for a year for transition, which the seller did not want to do at all. He did not want to make money for someone else. So we thankfully were able to negotiate the transition time to 6 months, and everyone was happy. The transaction went through. I've done 2 different engagements, separate occasions for IVF clinics. One of them was in San Francisco. Another one was in LA County. Very interesting about this one was both of them had buyers from China. So it was very interesting engagement. A pediatric clinic in Orange County. Then it was pretty standard pediatric practice. Was a medical dominant clinic. There's many things that medical clinics are not desirable. However, some buyers they are. We sold that clinic to a federally qualified health center, and the physician was able to stay on and work long into, their plan is to work the next few years and part-time schedule, and a lot of sellers do that. They they don't know what they're going to do after they sell the practice, so they'd like to have option to work a few days a week and travel, maybe see grandkids, etc. That seller in particular was able to do that. A few more. This one was a primary care clinic with a focus on LGBTQ community. It was in southeastern US. Extremely desirable practice, very profitable, had great contracts. It was a single owner MD. There were 4 PAs, and it was purchased by a very well-known nonprofit. Again, on that one, due diligence took us a few months, but the transition was about 12 months. They wanted the seller to stay for 6 months on the premises and another 6 months remotely. We worked on an internal medicine practice sale in Southern California. The interesting thing about this one, it had a contract with this exclusive contract with this one IPA, and that made this practice extremely profitable. I mean, it was a single doctor. After expenses, it was pulling $1.3 million in SDE. Very rare. It's not normal. However, as you can see, more than half of that profit that SD was coming from large IPA bonuses. I think these numbers were for 2021, I believe. So the SD was 1.3 million, and 700,000 of that was a bonus. The tricky thing was with that, on paper, it looks great. It's making a lot of money, but these bonuses are not guaranteed to happen again. So as a valuation analyst, you need to find those non-recurring expenses, but also non-recurring income, and factor that into the valuation. Also, the IPA in this case, because of that contract, had a first right of refusal. So before this, it was sold to an individual doctor from LA, I think, as well, from LA, and they had to wait for the IPA to take a look at the practice and say that they're not interested in taking it over, and only then the IPA issued a contract, same thing, exclusive contract to the buyer, and we were able to sell the practice. And lastly, this is an internal medicine practice in LA County. 100% of the patient base are foreign speaking, and so in this case, we don't just need to find any kind of buyer. We had to find a buyer who not just spoke the same language, but spoke the same dialect. In evaluation, we need to consider that as well. If the pool of potential buyers is smaller, valuation will be different. Bottom line, if you're a seller and you're in a good position to choose a buyer, wonderful. I'm super happy for you, and I hope you're happy with the transaction and the offer that was made to you. However, if you're not, you don't have a choice of buyers, give it time and just make sure you keep an open mind. Like keep an open mind is the most important thing. Plan. It takes about 12 months to complete a transaction, plus there'll be a transition time required by buyers. It depends on the buyer for how long they will want you to stay. As I mentioned, like hospitals like you to stay for a long time. Individual doctors, it kind of depends on the practice. I would say average is probably a few months. So once the sale happens, you get paid, you stay on a couple of months introducing patients to the new buyer. You see patients, you get paid for your time. We negotiate the compensation that you're going to get paid for your time post-sale. Usually it's an hourly comp or some kind of salary. And in the end, yeah, like few months, 6 months sometimes. Speak to a professional about market conditions in your area and in your specialty. That's pretty important. Before you slow down, the most important thing is don't slow down before you sell, because it doesn't matter how much money you were making even 3 years ago, even 2 years ago. The buyer is very risk averse. They're going to be worried that, hey, as it is, you're going to buy, let's say, a primary care practice, there'll be some attrition for sure. So they're not going to pay you you were making millions of dollars 2 years ago. They will factor that. They can factor that in. They'll consider it, but ultimately what matters is what you made last year. And the year before that, last year, most important, and how that changed year to year. So speak to a professional early on. If it takes them a year to sell, try to speak to someone, at least a year before you plan on retiring. I would say a year and a half, maybe at least be a good time. And understand what's the market like today, how long it takes to sell. Am I even going to be able to sell the practice given the specialty that you have? And just figure out what the value is. Get a valuation. It's a great tool. It's a great planning tool. It will tell you how much you can count on when you retire from the value of the practice. And it will give you an idea of, obviously, since you're going to talk to someone, how long it will take to achieve that. And that is all. I think I'm a few minutes early. I'm happy. Thank you so much for your time, first of all. I hope you learned something new about the valuation process, and I'll be happy to answer any of your questions.
All right, so we have one question. What does an evaluation cost?
Valuation cost can depend. It depends on of course, on the practice, right? If I'm valuing 10 location, 20 physician practice, it'll be very different from a solo practitioner, and the valuation purpose will if evaluation is for divorce, you need a certain type of report. It'll be more expensive if you just want to know the value of the practice. So I would say for a solo doctor, somewhere like $4,000, and it takes about 2 weeks. So if just like single specialty, single doctor, thereabouts.
All right, thank you. Are there any other questions? You feel free to enter in the chat, or you can unmute yourself as well. All information will be emailed to everybody tomorrow, and I'll also include Alex's information, contact information, if you'd like to reach out to him directly. So if there aren't any questions, any other questions? All right. Okay, Alex, I think.
I have a question.
Oh,
Of course.
My name's Dennis Sanchez, and I have a practice with probably 3 to 4 PAs and nurse practitioners. I'm a medical doctor, and I've already kind of slowed down. I'm maybe working 15 hours a week, and so essentially I do some management on the side, of course. But so I don't know how that would affect, since most of the PAs and nurse practitioners are running at least the clinical part of the practice, how that would affect the valuation.
Sure. It's actually could be a very good thing. The comment that I made about don't slow down, especially applies to solo doctors because they're the source of income. So if you are a doctor, you work 15 hours a week, but you have 4 other providers, obviously we look at the business as a whole. So in fact, if you have a business where, if you're I'll give you an extreme example. If you have a business, let's say you have your practice and you're an absentee owner, you don't do nothing, right? And the business generates cash flow for you. That is very valuable, right? What essentially matters is what you make there in total, like that SD that I told you about, and what you put into it. So if you make a lot of money and you put in 15 hours a week, that's awesome. That's great. So conditional, there will be a condition though that the buyers of your practice, I don't know if you want to just know the value in general. I understand like the value, the process of selling. For the valuation, what I care about is how profitable this thing is. If you have, doesn't matter how much time you put in, because I'm going to normalize your compensation anyway. So in the end, it's going to be about that. Let's call it EBITDA, right? The cash flow that the practice generates. If you work less, that's a good thing. Also, from perspective of selling, the buyer will want to be sure that all those PAs are going to stay, right? You don't want to tell them, the PAs, that you're going to sell the practice or transition out of it. You will first, find the buyer, agree to terms, do the due diligence, everybody's happy, and then right before closing the deal, I would say maybe a month before, not much, longer than that, have a meeting with the providers and introduce them to the new owner and whatnot, because they're part of your practice. If they all quit, the buyer is going to be, in bad shape.
Yeah, and one more question. As far as I always thought, hospitals and health systems would be the most aggressive in buying the, primary care practices because we feed them the patients. So I was wondering how that goes into the evaluation, and you mentioned that I might have to stay for 5 years, but that's probably not something I'm going to be able to do or want to do, actually.
Yeah.
So I was wondering, do some of them, and I have good relationships with a lot of, hospitals and IPAs and stuff. But if that's usually a requirement to stay for, so many 3 to 5 years or whatever.
The terms I've given are very generic, right? This is what I see normally. It's possible that they have replacements for you, especially like I think primary care would be easier. Like if there's it's like a specialty group they're buying, like an ENT group, and some of the doctors on that group, like they're let's say they're 4 doctors and they're all owners and they're extremely productive, or they do some very specific procedure that nobody else can do, then they need them, right? For sure. For primary care, easier, but ultimately hospitals, because they receive money from the federal government, they are restricted in terms of what they can pay. That restriction is fair market value, which is what I talked about essentially here. So their limit is they cannot overpay. So they cannot pay you more than fair market value. They can pay you nothing and they will be okay because they're not wasting government money essentially, right? So they will usually hire a third party, another valuation firm, usually a large one, to do a valuation for them. And that valuation report will say the value of the business, let's say $1 million. They don't have to pay you $1 million. They can pay you 500,000 if that's what you're going to accept and be okay with it. So that's their limit. That's their angle. They are aggressive. They are, it's been years. I've been doing this for 8 years. And as long as I've been doing, they've been buying practices, especially in California and, other states as well. I get a lot where people say that, they cannot get anything from the practice from a hospital. So I just want to be sure you guys are aware that you can, if you're in a position. If you don't have any buyers and the hospital is not willing to pay you, that's unfortunate.
Thank you.
My pleasure.
And there was another question on the chat asking, how does the valuation typically get allocated?
You're probably talking about different appraisal methods, right? Different approaches and different methods. It depends. So there are different schools of thought. The way that I was taught is that, if the values under different approaches are too far apart, weighing them, let's say 50, 33%, 33, it's just going to give you a number that is neither here nor there. I've seen valuations that are done this way. Some books teach maybe 80% income approach, 20% market approach, 0 asset. It is going to depend on the analyst. I go by, if I feel like my income approach is accurate and market approach is too low, I'll weigh 100% on an income approach.
Got it. And another question is, please discuss the timing of notice to patients.
So this one is, you have to go by what your malpractice carrier says and what your medical board, the California Medical Board says. Usually it's 60 days. So if you're going to close the practice, you got to, there's no transition, no one buying it, you closing down doors. You want to give your patients enough time to find someone else. So it's 60 days usually.
Got it. And next question is, do you negotiate for doctors with buyers?
Yes. So our firm does practice sales and valuations. So we do both. Yes. A lot of times, we'll do a valuation, and then we'll help with the selling process. We'll negotiate.
Okay. Another question is, how do you market a heavily Medi-Cal practice to an FQHC?
We market to everyone, to be honest. It only takes one buyer to buy the practice, but you want to bring as many people to the table as you can. You obviously can look up FQHCs in your area and see if they'll be interested in looking into it. I think there are websites where you can look up an FQHC by like a zip code or by city. So the FQHC, I've done valuations for FQHC, and we've sold practices to a few FQHC, of federal qualified health centers. The ones that I've worked with, like hospitals, are a little bit more sophisticated, I think, in the way they approach valuations. Like they've done more of them. I think FQHC is kind of new thing, so they heavily relied on me essentially in all of those engagements. They were seeking my advice on the value and is it reasonable, because FQHCs also have to comply, because they also have to comply with fair market value standard. They cannot overpay either.
All right, and then going back to the previous question of how does the valuation typically get allocated, there was some clarification. What was meant was how much of the purchase price gets allocated to goodwill.
Oh, good question. In the very beginning, I talked about valuations for asset allocation. The way you would normally do this, in just a very simple situation, a doctor selling a practice, let's say a purchase price is $500,000. You would allocate it across fixed assets, covenant not to compete, and goodwill. Fixed assets, I mean, if it's a primary care practice, you don't need to get an appraisal. You can ballpark it. Okay, it's 10,000, 15,000, whatever it may be. Put that at 15,000. Covenant for non-compete covenant, it kind of depends. You don't in the transactions we don't try to figure out the value of non-covenant, because that's a very complicated valuation. So we allocate some money for the covenant, and the rest goes to goodwill. I've just recently done a valuation for a family doctor in LA County. They were selling it's a pretty good sized practice. They were selling it to another group, and I've done the valuation for them, and they entered into agreement to sell the practice, and they went back to me to do a valuation of personal goodwill. So your goodwill essentially is value that is intangible, right? You can always count, what kind of equipment you have, what it's worth, how much cash you have in the bank, what your AR is worth, ballpark, and you know your debt. Goodwill is all the intangible. It includes everything. Sometimes you can identify it, sometimes you can't specifically identify it. But the goodwill can be split into enterprise goodwill and personal goodwill. So personal goodwill, it's the value of the owner of the owner brings to the table. So if you have a doctor who is very well known, their name carries a lot of weight. Patients go to this practice because of that doctor. Like they know about him and they want to go there to this practice. That's personal goodwill. Enterprise goodwill, essentially everything else, the location, the receptionist that you have, your patients love your receptionists, they come back to the practice because of that, it's convenient, et cetera, et cetera. So I had to do, they asked me to do a valuation of personal goodwill specifically because I believe they sold it separately and they had quite a big tax benefit from that. But they needed to attach a valuation to their tax forms to specify, how they got that number, and they need an evaluation analyst for that.
All right, and then one other question. What about the timing of patient notice when new doctors are coming in?
So in this case, you're not, again, this is not advice. You want to still talk to the Medical Board of California and to the malpractice, but since you're not leaving patients hanging, there will be someone else to fill in. What usually happens is once the deal closes, the buyer and seller will draft a letter that will go out to all the active patients. We usually recommend patients that were seen in the last 24 months before closing. And then that letter, you'll announce whatever is happening. You're retiring, you're moving, you probably will stay there. So the letter can say, hello, my patients, I'm planning to retire. I'm happy to announce that Dr. So-and-so is taking over my practice, include some information about the buyer, mention that you'll still be around for the next 3 months, come and see me, and I'll introduce you to the new owner, new doctor in the office, and you send those out.
And what would be the timing for that?
After closing.
After closing.
Yeah, so after closing. I didn't think there's like a requirement because patients are going to be, again, taken care of. You just want to do it helps the buyer as well it's not like a shock to patient that, oh, there's a new doctor in there. You do it at closing, right after closing.
Got it. All right. Does anybody else have any other questions? As I mentioned, I'll be going ahead and sending everyone a copy of the presentation tomorrow, along with Alex's contact information, if you weren't able to write that down. All right.
Great.
Okay.
Thank you so much.
Thank you so much, Alex.
Pleasure.
Alrighty.
Thank you.
Good night.